Minimalism has been a thing during recent years. It originally came from visual arts, music, and other media in the 1960s. This concept has gradually evolved and penetrating our daily lives. In this era, minimalism basically refers to achieving more by owning less or owning what we only need. Nowadays, we are pampered with a lot of choices across different aspects of our life, including choices of investment vehicles. What is up everyone, this is Jin Hao. Thank you for tuning into this video and I wish you are doing well. Here in my channel, I share about my personal opinions and experience on my journey in investing, trading and personal finance just like this one. So if you are new here and you are interested in these topics, consider subscribing. And in this video, I'll be sharing with you my minimalism investment portfolio, which consists of only 3 ETFs. But before we proceed further, as usual, disclaimer, I'm not a licensed financial advisor and I'm not licensed to give you any financial advice. Whatever I share in this video are solely based on my personal opinion and experience. Securities mentioned in this video are solely for educational purposes only and there are no buy or sell solicitations. Do your own due diligence and practice independent thinking when it comes to consuming this type of content on the internet. Alright, let's move on. Now let me explain a little bit why we are even talking about this minimalism thing in investing. Down my journey of investing and trading, I have seen way too many people holding too many stocks or funds altogether. If we were to put the issue of over-diversification aside, from what I have seen, most retail investors are not capable of handling and monitoring portfolios that consist of too many positions in it. I've personally met a person who had more than 100 stocks in a single portfolio and she ended up forget what she has bought. The worst part is some of the stocks have already been delisted and she was not aware of that. That is just terrible. She would have achieved better results by just buying into a high quality ETF which is already pretty diversified. For retail investors who have limited time to study about individual stocks or just do not know what stocks to buy, investing in index funds or ETFs is always a recommended strategy for a couple of good reasons. First, it is very diversified. ETFs would have at least 15 or 20 stocks up to a few hundred stocks. Second, it allows our limited capital to be exposed with great companies at a very small cost. Imagine you want to buy and invest in the top companies in the US like Microsoft, Apple, Google, Amazon, Facebook, and so on. You will need thousands and thousands of dollars if your brokers do not allow you to buy fractional shares. One share of Amazon alone is already more than $3,000 and Google is more than $2,000 a share. This is already out of the reach for the majority. The better way would be investing into index ETFs that hold these stocks with only a couple of $100 per unit. Third, index is created to go up in long run and index ETFs are created to track the movement of the index, which also means index ETFs theoretically would go up in long run, especially those top indexes that have been proving themselves for a decade or more. When you invest in a company's stock, theoretically, your investment would become worthless if the company turns really bad and the stock crashes to worthless. Theoretically, this could happen, but of course, as an investor, you can sell the stocks before things become worse. However, on the other hand, index is more likely to go up in the long run because if any company that is included as an index component were to become a non-performing or fall in performance, it would be expelled from the index and replaced with a better candidate to become the new index component, just like Tesla being included in the S&P 500 index on December 2020. In other words, it is safer to collect high-quality index ETFs when the market falls or crashes as opposed to investing into individual stocks because retail investors like us are usually not so great in market timing. Oftentimes, when retail investors try to do some bottom fishing, the stocks end up going lower and some of them never even recover after the market recovers. So in this regard, especially for non-professionals, it is safer to build a portfolio with high-quality ETFs and invest for the long run as the indices will always include the best stocks within the entire markets, region, or in some cases, sectors. In my previous video, I also shared that when trading does not make sense, it will usually make some sense to channel a portion of our funds to invest. And to get this done, one of the best ways is investing into great index funds or ETFs. You can kind of treat this as the part 2 of that video. If you haven't watched that video, be sure to check that out after watching this video. I'll link it in a YouTube card as well. So since ETF itself is already a very diversified investment, it does not really make much sense to me to invest in like 10 different ETFs. I don't think that would be very useful as it would be way too overly diversified. Unless there are some sectors or countries whereby you think they will have some momentum, then investing a little bit in those related ETFs is fine. But if that's not the case, what I'll be sharing with you in this video is 3 ETFs that you should look into. Unless there is any fundamental change on how these funds invest, this minimalistic approach of ETFs investing is going to be almost evergreen. Alright, so let's begin with the first ETF. The first ETF that you should include in your investment portfolio, and if you can only afford to accumulate one ETF only due to budget constraint, this is the ETF that you should be looking into, and it is none other than the S&P 500 Index ETF. Now, for this, you have several choices. You can go with what most investors would prefer, which are VOO, Vanguard S&P 500 ETF, or IVV, iShares Core S&P 500 ETF, as they have class-leading expense ratio of 0.03%. They are basically the same thing from different issuers. The return is nearly identical as well. If you are like me, who prefers something with higher liquidity and being able to write covered calls for every 100 units you hold, then you should look into the SPY, which is the S&P 500 Index ETF by SPDR. The expense ratio is higher than VOO and IVV at 0.09%, but again, this is still very little compared to other ETFs. And just to clarify about SPY is having higher liquidity, VOO and IVV do have great liquidity as well, just that when we compare them next to another, SPY is the champion when it comes to liquidity, as it has about 15 times higher average volume at the point of recording compared to the other two. And for investment purposes, liquidity shouldn't be a major concern anyway. Now, let's talk about why S&P 500 Index ETF or fund is a great investment for long term. The S&P 500 Index comprises 500 US largest publicly traded companies like Microsoft, Google, Apple, Amazon, Facebook, Berkshire Hathaway, JP Morgan, Visa, and so on. It is often the benchmark measure for annual returns. When people say the market, they usually mean the S&P 500. In 1926, this composite index is created as a 90-stock index as a benchmark for US stock market performance, and in 1957, it was being expanded to carry 500 companies and renamed into S&P 500 Stock Composite Index. The average annualized return for the S&P 500 index since inception in 1926 is approximately 10%. The average annual return since adopting 500 companies into the index in 1957 is roughly 8%, and the average annualized return for the past 10 years is about 11%. So to me, the S&P 500 Index ETF is well diversified. To a certain extent, it is overly diversified. But what matters the most is the consistent return that it has delivered in the past 9 decades, almost a century. If you do not have extensive knowledge with investing or analyzing individual companies and things of that nature, this is where you should put your money. And this is recommended by Warren Buffett as well. So now let's move on to the second ETF for this minimalist investment portfolio, which is an ETF that tracks the movement of the top 100 stocks in NASDAQ, and that is the Invesco QQQ Trust. And for more than a decade, NASDAQ has been outperforming the S&P 500 as technology is booming. The average return of NASDAQ for the last 15 years is slightly above 10%, and for the last 10 years, the average return is over 14%, which is higher than the S&P 500. If you believe that technology is still going to be something that we cannot live without, is going to be something that would still be significant or important in our daily lives for the next 5, 10, or 20 years, then you should look into this as your investment choice, as 48% of the holdings are in the technology sector. Now, some might condemn the idea of investing in both the S&P 500 Index ETF and QQQ together because the top holdings of these two ETFs are very similar. Even in the top 15, the repeated names are Apple, Microsoft, Amazon, Google, Facebook, Tesla, and Nvidia. And these companies are heavily weighted in both ETFs. However, to me, it is never an issue because these are index funds, and the best companies will always have heavier weightage in the indexes, and also the funds tracks the indexes. So to me, if my money is exposing to the companies that are leading the world right now, it is never an issue, as the objective of my investment portfolio is not to speculate growth of those small or mid-cap companies. And now let's move on to the third ETF. For this, we are going to get some exposure in the Chinese market. If you believe that China is going to become a stronger country from an economic standpoint, then this is an ETF that you should consider looking into. And this ETF is called FXI, which is the iShares China Large Cap ETF. FXI is a very popular choice of ETF to gain exposure in the Chinese equity market and offers great liquidity. With FXI, you have exposure to the top 50 largest Chinese stocks in a single fund. Many years ago, this is not a great investment, at least to me, because it used to hold mostly companies in the financial sector. At the point of speaking, this fund has a 35% exposure in consumer discretionary, 30% in financials, 14% in communication, around 6% in healthcare, 5% in real estate, and so on. One thing that I should point out is comparing to previous two funds, this can be a little bit more volatile as this ETF comprises of 50 companies, whereby the S&P 500 Index Fund has 500 companies and the QQQ comprises of top 100 companies in the Nasdaq. Not a very big deal, but I think I should point it out. The top 3 holdings for FXI at the point of recording this is Alibaba, Tencent, and Meituan, with the weightage of around 9.1%, 8.7%, and 8.3% respectively. More than a quarter of its holding is exposed to these 3 companies. If these 3 companies are going to perform well, then happy days for you. And of course, do not forget the opposite. But comparing to other ETFs investing in the Chinese equity market like MCHI and KWEB, the exposure of FXI to these 3 companies are actually the lowest. Before we end this video, let's talk about the weightage of each fund for this minimalist investment portfolio. For now, I'm holding SPY, QQQ, and FXI in a 2 to 2 to 1 ratio, which means 40% of the portfolio is holding SPY, another 40% is holding QQQ, and the last 20% is holding FXI. They are not accurate to cents, and if one outperforms another, the ratio will immediately change, and I'll need to do a portfolio rebalancing if I want to continue keeping the predetermined ratio. I would say among these 3 ETFs, the S&P 500 is more like a defensive pick among these 3. I decided to keep QQQ at the same ratio with the S&P 500 Index Fund because I'm very optimistic with the technology sector in general, at least for the next 10 years or longer. Just imagine you were to live in the way that you lived 20 years ago, how would that be? As for FXI, I keep it at only around 20% of my investment portfolio because it is more volatile among the 3, and also, to be honest, the return of this ETF is not that interesting historical-wise. The reasons I'm allocating this ETF into my portfolio are diversifying the exposure out from the US market a little bit, as well as the economic growth for China, especially post-COVID. So that'll be all for this video. I hope you like this video, and if you find this video helpful, do not forget to smash the like button and share this video to people who may find it beneficial. In the upcoming videos, I'll be sharing with you some alternatives to the S&P 500 index ETFs and Nasdaq index ETFs, as the above mentions are priced at a couple $100 per unit, which may be already out of the reach for some people. So if you want to know more about that, do not forget to subscribe to this channel and hit the notification bell so that you get notified when it is uploaded. Meanwhile, feel free to check out my other videos that you may find it helpful. Thanks for watching, and I'll see you soon. Stay safe and healthy. Bye for now.